really like Bolivia. And you say, well, but last year you liked Sri Lanka. And it's just, we're not comfortable with that.
Yeah. And we usually think it's a lot of baloney, but
that's why we're not comfortable.
We don't really start out looking to either emerging markets or specific countries or anything of the sort. We may find things, as we go around, but it isn't like Charlie and I talk in the morning and we say, it's a particularly good idea to invest in Brazil or India or China or whatever it may be. We've never had a conversation like that, have we, Charlie? No. And it just won't happen. We don't think that's where our strength is. And we know that our strength is not there. And we think probably most people's strength isn't there either. I mean, it sounds good, but I don't really think it's the best way to look at investments. If you told me that we could only invest, we're perfectly willing to do it. We owned a lot of PetroChina at one time. We own some BYD now. We've owned securities outside the United States and will continue to. But if you told us that we could only invest in the United States the rest of our lives, we would not regard that as a huge hardship.
You have mentioned that you are 85% Benjamin Graham and 15% Phil Fisher. And you have also said that if you only had $1 million today, you could generate 50% returns. Since I'm a young investor, this is my question for the both of you. How was your investment strategy different when you were still accumulating money as opposed to managing billions? Did you focus on specific industries, small cap, large cap, etc.? Thank you.
Well, managing $1 million is an entirely different game than running Berkshire Hathaway or running some $20 or $50 billion fund of money. And if Charlie and I were running $1 million now or 100,000, or we would be looking in probably some very small things. We would be looking for small discrepancies in certain situations, and the opportunities are out there, and periodically they're extraordinary. But that's something we really don't think about anymore, because our problem is handling 12 or 14 billion or whatever it might be coming in every year, and that means we have to be looking for very big deals and forget about what we used to do when we were very young. Charlie?
Yeah, I'm glad I'm through with that particular problem.
He worked pretty hard at it when
yes,
we both did.
Did we ever?
Yeah. We looked under a lot of rocks, and
I used to make big returns on my float on my own income taxes. Between the time I got the money and I paid it to the government, I frequently made enough money to pay the tax. But I was working for small amounts of money and doing anomalous things.
He didn't tell me how to do it, though. You always want to accept an option. You never want to give an option. But the life business is in just the reverse side of that. Actually, the mortgage business, I mean, Charlie and I were in the savings and loan business. The idea of giving somebody a 30-year mortgage where they can, if it's a good deal for you, they can call it off tomorrow, and if it's a good deal for them, they keep it for 30 years. Those are terrible instruments. They're good for you if you're buying a house, and I recommend everybody in this room get a 30-year mortgage immediately on a house for all they can. Because if it's a bad deal and rates go to 1%, you can refund it. And if rates go to 6 or 7%, maybe you can buy it back for 70 cents on the dollar or something of the sort. So the life companies have engaged in that big time in the last few decades, and a lot of them are paying the price, and some of them haven't even realized exactly quite what the problems are. They're kind of like the fellow in the switchblade fight, where the other guy takes a big swipe at him with a switchblade, and the first fellow says, "You didn't touch me," and the other guy says, "Well, just wait till you try and shake your head." Well, that's a little bit like where some of the life companies are right now, Charlie. Anything further, Charlie?
No, that's gloomy enough.
Okay, station 9.
I took finance in university, couldn't understand Greek formulas, but now I can invest reasonably well. My question to you is, in the past you've said for an investor you should simply, for 99% of investors, you should simply stick money in an index fund and let it go and don't worry about it. Those 1% of investors, choose your best 5 stocks and put a substantial amount of money in it. I'm just wondering, how about a strategy of perhaps buying 20 of the best stocks in America, you know, Procter & Gamble, Coca-Cola, Johnson & Johnson, whatever, the companies that have been around for centuries, or a century or decades or whatever, and just leaving it at that. Do you think that would outperform an index fund over the long term? And I want Charlie's opinion as well.
Well, it's a little bit of I don't know whether you're saying the 20 largest companies, the 20 best, you might get different thoughts from different people on what they are. But I think you would, probably the 20 you would pick would virtually match the results of an index fund. Who knows exactly which ones would be the best. But the real distinction, and Graham made this in his book, basically, is between the person who is going to spend an appreciable amount of time becoming something of an expert on businesses, because that's what stocks are, or the person who is going to be busy with another profession, wants to own equities, and actually will do very well in equities. But the real problem they have is that they may tend to get excited about stocks at the wrong time. Really, the idea of buying an index fund over time is not to buy stocks at the right time or the right stocks, it's to avoid buying them at the wrong time, the wrong stocks. So equities will do well over time, and you just have to avoid getting excited when other people are excited, or getting excited about certain industries when other people are. Trying to behave like a professional when you aren't spending the time and bringing what's needed to the game to be a professional. And if you're an amateur investor, there's nothing wrong with being an amateur investor. And you just simply, you've got a very logical, profitable course of action available to you, and that is simply to buy into American business in a broadly diversified way and put your money in over time. So I would say your group of 20 will probably match an index fund, and you'll probably do well on that, and you will do well in an index fund. Charlie?
Well, I've got nothing to add. I do think it's that knowing the edge of your own competency is very important. If you think you know a lot more than you do, well, you're really asking for a lot of trouble.
Yeah, and that's true outside of investments,
yes.
too. Yeah.
Works particularly well in matrimony.
Do you want to give any other advice on this subject?
If I'm in my 20s and I'm starting a partnership, what advice do you have about getting people to put in money before I have a track record as a solo investor?
Well, you haven't sold me. No, I don't. I think people should be quite cautious about investing money with other people, even when they have a track record, incidentally. There are a lot of track records that don't mean much. But overall, I would advise any young person that wants to manage money and wants to attract money later on to start developing an audited track record as early as they can. I mean, it was far from the sole reason that we hired Todd and Ted. But we certainly looked at their record. And we looked at a record that we both believed and could understand, because we see a lot of records that we don't really think mean much. I mean, if you have a coin flipping contest, as I wrote, some years ago, and you get 310 million orangutans out there, and they all flip coins, and they flip them 10 times, you will, instead of having 300 million left, you'll have 300,000 roughly left that'll flip 10 times in a row successfully. And those orangutans will probably go around trying to attract a lot of money to back them in future coin flipping contests. But so it's our job when we hire somebody to manage money to figure out whether they've been lucky coin flippers or whether they really know what they're doing.
When you had his problem, didn't you scrape together about $100,000 from a loving family?
Yeah, well, I hope they kept loving me after they gave me the money. That was it was very slow, and it should have been very slow. As Charlie has pointed out, some people thought I was running a Ponzi scheme probably there, and other people may not have thought it, but they thought it was to their advantage to sort of scare people because they were selling investments in Omaha. But to attract money, you should deserve money, and you should develop a record over time that does it, and then you should be able to explain to people why that record is a product of sound thinking rather than simply being in tune with the trend or simply just being lucky. Charlie? You're starting today and you're 25 years old. How do you attract money?
Friends and family, or people whose trust they've already earned in some other way. So it's hard to do when you're young, and that's why people start so small.
And a relatively few will be successful.
That's right, too.
Yeah. A great many will be successful and make, we had the hedge fund record here, and during that time, the hedge fund managers have probably made a very considerable amount of money. As I pointed out, Todd and Ted, working under a 2 and 20 arrangement, if they put the money in a hole in the ground, would make $120 million each this year.